off with Barclays and these job cuts. Has Jenkins gone far enough, or is it too little too late?
Well, I think given that Jenkins is only part way through his 5-year plan, it may not be too little too late, but certainly from the factor of putting a bad bank into place, he is probably about 3 years too late there. I think UBS may have actually mentioned that this was a possibility and it should be done about 3 years ago, and they were accused of scaremongering at that particular time. So it now seems that we have reached a particular point that this needs to be done. But as to whether or not this will assuage the shareholders, or whether or not this will help the profitability of the bank, given how dependent it's been on fixed income in the past, really remains to be seen. And judging by the share price and the falls we've seen over the last quarter or so, and the fact that it's below that £3 mark for quite a long period of time, even though we are off its lows since the beginning of April, I do feel that shareholders are going to take an awful lot if they're going to get back on board with Antony Jenkins.
Now, do you think shareholders, Brenda, worry that there are more toxic assets lurking in the cupboard?
I think that has always been the issue with bad banks. Clearly the idea of a bad bank is to remove the toxic assets, put them somewhere else, and hope that you can regain the trust and confidence from your investors, and hopefully gain some sort of profit from the bad bank proceeds. But of course there is that possibility that they will not be able to be 100% certain on what assets are toxic initially, and whether or not this will be the end of it. So there will always be that feeling that perhaps there will be more non-performing loans that will need to be placed there, and of course that will put pressure on the share price.
Now, do you think the cuts we've seen and announced today will actually improve the return on equity for the investment banking unit? Because last year they were still performing under the cost of capital.
Well, that is probably the biggest issue that the Jenkins actually faces, and I think if you compare the likes of Barclays to perhaps even JP Morgan or UBS, its dependency, as I said, on FICC is a lot more. So it's going to take some doing to get there, but clearly cost cutting is necessary. But the one area that it is doing reasonably well in as well, rather resilient, is its retail arm, and that is one area that is also going to be seeing job cuts. So I think the jury is still out on whether this is actually going to work, and I would prefer to see the share price clamber back above the £3 mark if I was really to get a bit positive about it.